goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Getting fucking rich. I want my fucking money.
Stay up, Kenny.
Griffin, I want my fucking money.
Jay Powell, get the money.
Yo, motherfucker.
Janet Yellen, I ain't selling.
Holy shit, we're gonna be so fucking rich. Great. Damn it, we're gonna be so fucking rich.
Welcome back.
Griffin, I want my fucking money.
You're an original,
Hey,
aren't
yelling,
you?
give me the fucking money. Get the goddamn money printer out.
Great. The bounty cutter.
Let's
We're
go.
gonna be so fucking rich. Get the goddamn money printer out.
All right, guys, here's what's going on. GME has finished their share offering, has a ridiculous amount of cash on hand, and they're about ready for mergers and acquisitions, it appears. I think that's probably what's coming next. So in case you guys didn't know, a couple weeks ago, actually on May 17th, sorry. This one here is an update to the prospectus. But a couple weeks ago here in September, GameStop announced that they'd be selling more shares here on September 9th, it appears. Long story short, they sold 20 million more shares of GameStop stock. And that gave them an additional $400+ million on top of the cash that they already had. And the most ridiculous thing about this is that their market cap is only $9.5 billion. They have almost $5 billion in cash on hand. And their market cap is $9.5 billion as of right now. Now you can see somebody was buying up all these shares. There's been a large number of dark pool prints. And a lot of these dark pool prints come from payment for order flow brokers, buying orders from brokerages like Robinhood, Webull, IBKR, Schwab, etc., and then processing the orders via dark pools. And they do this because dark pools limit the stock price. Yes, they actually prevent the stock price from going up as much as they would if the orders had been purchased on a lit market. Sadly, a lot of retail investors still don't know about this, are not routing their orders directly to lit exchanges, or their brokerages don't even allow them to. For example, like Webull, Schwab, Robinhood, you can't route your orders to lit markets. But if you could, the stock price would be going up a lot more. That is an absolute factual guarantee that has been stated time and time again by all sorts of market participants, regulators, even Gary Gensler himself. The stock price is doing well. $22.31 and actually higher, somewhere in the range of $22.68 as of the moment right now in the after hours. It's been up over 10% over the last 5 days in spite of this share offering, or should I say, maybe even because of this share offering. Jeffrey, I see you say you route your orders to IEX. Fantastic, my friend. Fantastic to hear. I know it's complicated. I know they give you a lot of hoops to jump through, but the fact that you're routing the orders, look at this stupid camera got stuck. Whatever, I guess we got one camera that's not moving. But the fact that you route your orders is fantastic news all around. I wish more people would do it. Unfortunately, most people are using brokerages in which you can't route your orders. However, that's why we're coming up with a new brokerage that will automatically route orders to lit markets called Lit Exchange to avoid payment for order flow from price distorting dark pools. It's really simple. And again, we came up with the idea for that because we're tired of the manipulation that happens because of payment for order flow, because of the wholesalers, because of the brokers, and the dark pools that are used to suppress stock prices. So GameStop has completed the at-the-market equity offering program, and this information just came out today. Grapevine, Texas, of course, right here. I just moved over to the Dallas, Texas area myself in order to launch Lit Exchange, and we were really excited for what's coming in the near future. You can own equity in the company now if you'd like. You can use the link above and check out our offering on the SEC Edgar website and on the FINRA-approved FINRA-approved funding portal, Silicon Prairie. There's a link to it on our website. So GameStop has disclosed on September 10th that they filed to sell a maximum amount of 20 million shares. They sold the maximum number of shares registered under the At the Money program for aggregate proceeds before commissions and expenses of the offering, of course, because all offerings have commissions and expenses associated with them. And they stated GameStop intends to use net proceeds from the At the Money program for general corporate purposes, which may include acquisitions and investments. And really, the writing is on the wall here, guys. Ladies and gentlemen, I should say, because I know there's a lot of lady investors here as well. So huge respect to you guys. Hey, Nat, Typo, and John, Chris, welcome, ladies and gentlemen. There are mergers and acquisitions on the horizon here, with GameStop having more than $4.8 billion in cash on hand. This is huge news, and I think, as I showed you guys on the last, basically on the last report, that the earnings report that GameStop came out with, they are cash flow positive, and they had at the time $4 billion in cash on hand. Now, with this, they have over $4.8 billion in cash on hand, and their market cap is absolutely minuscule in comparison. Their market cap here is 9.5 billion shares. Sorry, $9.5 billion across 400 and something million shares that they've got now. Now it's around 420 million total shares that exist. But again, I showed you guys that as of their most recent non-GAAP results from their earnings report, they had a free cash flow of $65.5 million in net cash flow after capital expenditures this most recent quarter that just came out. As you can see here, this time last year, they were negative $231 million. Now, positive $65 million in the quarter for net cash flow, and on top of that has over $4.8 billion in cash on hand. The great thing is that they have now removed the restrictions. As you can see here, Bobby Cat posted this back in late August. It says, now that the credit agreement is gone, that removes the certain restrictions on investments and acquisitions that they were bound to from that agreement. And he is absolutely correct. This is directly from one of their from the SEC Edgar website as well. In this agreement, GameStop had restrictions that prevented them and limited them from doing investments, acquisitions, loans, guarantees, and other fundamental changes in dispositions, dividends, and distributions. They are no longer, because they have paid off all of these debts and removed themselves from these covenants, they are no longer bound by these restrictions. That means that GameStop now, with over $4.8 billion in cash on hand, this new 8K that has removed these restrictions against them, and a mere $9.5 billion market cap, have an incredible incentive to restructure the business in a way where they become similar to an investment firm such as Berkshire Hathaway, in the form of merging or acquiring other companies that will allow them to greatly increase their revenues, profits, and sales overall, and not just strictly related to gaming. This is something that is going to hugely impact them in a positive way. And I believe that this will be very good for them overall. I think many of you guys will agree that what we're seeing now on GameStop, including even some positive movement on the stock price here in the after hours, is a pretty bullish signal. And again, you got to keep in mind, in the after hours, most of the manipulation that occurs is always prevalent, but most of the movement that occurs in the stock, like GameStop, has always happened in the after hours or in the pre-market before the market is open. Because during the actual market hours being open, there are limit up and limit down halts that are greatly manipulated to prevent the stock price from moving in a large way in either direction, up or down. But of course, as you guys already know, they have no interest in protecting the stocks from moving down in price. The protection is from their own margin calls and preventing the stocks from moving up in price. The prints in dark pools that have been coming over in the last week or so have been incredibly massive. In my opinion, it is a sign that retail investors are buying up the stock, and market makers are preventing themselves from having to buy more stock by marrying call contracts with these shares. Now, I would like to bring something to your attention, guys, because I feel that some people are unaware or misconstruing, either coincidentally or accidentally, misconstruing the fact that this is bullish for retail investors, even though it's bearish overall when you think about it. And I know that sounds like kind of a conundrum, and it's not double speak or word salad. It is a fact that I stated here, nearly 100% manipulated in these stocks, as any payment for order flow buys or sells that are created by retail investors are purchased by brokerages and wholesalers like Citadel and Virtue. Citadel and Virtue are a market-making broker-dealer, amongst others, and they know how they're going to process the trade before they do so. The entire point of payment for order flow is so that they can buy your orders from Schwab, so they can buy your orders from Robinhood, so that Citadel and Virtue can buy your orders from IBKR and E-Trade and Fidelity and all of these other brokerages, Public, etc. Even the ones that claim that they don't use payment for order flow because they're based in Canada, sell the orders, or should I say transfer the orders here to the United States to their partner subsidiaries, and then those partner subsidiaries here in the United States sell them to the wholesalers because they receive more in rebate. They receive more money in payment for order flow from those same subsidiaries. But again, that is why we've been telling people to avoid payment for order flow brokerages, but that's nearly impossible in the current climate. Market makers use married call strategies against stock purchased by retail investors to hedge their own risk. I've told you guys this many, many times. They use married and divorced puts and calls in order to prevent themselves from having to buy more shares, because that would make the stock price go even higher. This prevents them from, it allows them to limit their losses and manage their positions efficiently amidst increasing GameStop stock prices. This is not anything new. Look at these dark pool prints, these massive dark pool prints coming in here. 5,000 orders, 5,000 share orders here at $22.38, 5,000 at $22.82, 5,000 at $22.90, $22.99, $22.98. You get the idea, right? That's what's going on here. Retail investors are buying the shit out of stocks like GameStop specifically, and they're snatching up all those shares that have been issued out there by the offering. So the offering's out there. Retail investors are buying the shit out of the stock, and market makers are processing the orders in the dark pools. Your orders are being purchased from Robinhood, from Webull, from Schwab, from all these brokerages, so that they can front run your trades, so that they can process them through dark pools to prevent the stock price of GameStop from going up. and then to hedge themselves against their naked short positions. Because in case you didn't know, market makers use Rule 203BI exemptions in order to create synthetic shares legally. This is legal. It's fucking ridiculous, but it's legal. And I'm fucking tired of it. And I know a lot of you guys are too. In order to hedge their naked short positions, instead of buying the stock themselves, which would increase the stock price, they marry calls and puts with share purchases. A market maker uses the concept of married calls in their role as a liquidity provider to hedge risk or manage positions related to stock purchased by retail investors. They facilitate trades by being willing to buy or sell stocks and options at publicly quoted prices. They do this to ensure market liquidity. But the fact of the matter is that this creates synthetic, fake shares that are plucked out of the sky that do not exist. This is the literal definition of naked fucking shorts. And it's legal. That's the 203BI exemption from the market makers. And again, how does this affect you? Well, retail investors buy the fucking stock. When retail investors buy shares of stock, a market maker may end up with a short position because they sold the shares that they don't own, expecting to buy them back at a later price. And oftentimes they never buy them back, and that's called a failure to deliver. They FTD, and it's more profitable for them to FTD than it is for them to buy the shares back. That creates synthetic shares in limbo, exponentially growing over and over again over time. To hedge against their short positions, they do not buy the shares all the time. The market maker might buy shares of stock to maintain a long position or offset some risk, but that's not what always happens. In fact, they use call options, okay? In addition to holding the stock, the market maker could buy a call option on the same stock. This is a married call strategy, okay? And they marry these calls in order to provide them with the right to buy more shares at a specific strike price if the stock price rises. This is their delta hedge. This serves as a hedge in case the stock moves upward and the market maker needs to cover their short positions. They then exercise those call contracts. This is hedging against volatility. Market makers deal with the risk of these price fluctuations because retail investors can push the stock price up or down depending on their trading activity, but it is greatly suppressed by them processing these orders in the dark pools. And that is greatly suppressed by retail investors not routing their orders directly to lit markets. That's the whole point of lit exchange, in order to automatically route orders from retail investors to lit exchanges, like the NASDAQ, like the NYSE, like the IEX, et cetera, et cetera. Now, the married call strategy here allows the market maker to limit their risk. And if the stock price increases due to heavy buying by retail investors, the call option can be exercised to buy the stock at a lower price. This offers an offset to their potential losses on their naked short positions created legally through the market maker 203BI exemption. And when retail investors purchase a large volume of stock, the market maker may need to sell the stock to fulfill the order, potentially creating further short exposures. You following me? Robin, you cannot marry the stock, unfortunately, but the market makers can. That's what's really effed up about the whole situation. That's why I get so frustrated and so angry, because it's literal legal market manipulation enabled by the Securities Exchange Commission and the same players that regulate themselves. FINRA, everyone that sits on the board of FINRA sits in these companies. Goldman Sachs, Citadel, Virtue, JP Morgan, etc. These are the guys that are the same people that are on the limit up, limit down committee, or should I say from the same companies. You know, David Ings, the head of the DTCC, is also a member of Citadel. So there's too much. We monitor ourselves. We have policed ourselves and investigated ourselves and confirmed that we have done nothing wrong. And that's the problem with FINRA. That's the problem with all of these institutions and these self-regulatory organizations. And I'm confident and hopeful that RFK Jr. and DJT are going to come in and actually shake things up, because Devin Nunes, the CEO of DJT Truth Social, has been greatly vocal about this. And I have personally worked with the RFK Jr. administration for over a year now on how they can progress actual financial reform. I've showed you guys those emails in the past on this channel. So, subscribe and follow if you want to learn more and hear more about that. But I will be definitely trying to continue to work with them in whatever capacity possible to create actual financial reform for retail investors. So to protect themselves against these rising stock prices, which of course causes losses on their short positions, then there's naked short positions from the market makers, and the market makers are illegally working on behalf of their hedge funds to prevent themselves from going insolvent and bankrupt. So the market maker buys the same stock and also purchases a call option. This allows them to benefit from stock price increases or manage their position more flexibly. And of course, the call option allows them to maintain their risk, to be hedged without having to buy the frickin' shares. And so if the stock price moves up, they can exercise the call option, in which they never had to purchase the shares prior to this. And this allows them to purchase additional shares at the predetermined price. And so that was my response here to this awesome post by DRR4G3. He said he found it a little suspicious that the dark pool order for GME for 4.67 million shares matched the options calls that expired in the money, right? 100 shares per contract, 46.7 thousand shares, 46.7 thousand total, and then 4.67 million shares versus the 4.67 in the dark pools. Is this coincidence? And that was my reasoning for responding. It's not that it's coincidence. It's a fact that they know what they're going to process. They know what shares and how many shares they're going to have to hedge for and how many calls they're going to have to marry because of payment for order flow. The payment for order flow they use to buy your orders from the broker dealers, and the brokerages sell them your orders and allow Citadel and Virtue and these other market makers to front run your trades. They allow them to process your orders by the thousands, if not by the millions, in the dark pools. And then they can marry the calls before that actually moves forward. So in reality here, what we've been seeing over the last week, a 10% gain. Let me refresh this to see if any after hours movement, basically a 12% gain over the last 5 days. In reality, if those were actually going to lit markets, to lit exchanges, that would be exponentially, ridiculously higher. That might be 120% gain on the stock price of GameStop. It might be a 1,200% gain on the stock price of GameStop. And if you factor in the naked shorts, the short positions that were already married with the calls by the market maker because they used the payment for order flow to process your order in the dark pools. And before they processed the order in the dark pools, they knew exactly how many calls to marry. If they didn't have that information ahead of time from these broker dealers that they were buying it from, the stock price could be exponentially higher, theoretically speaking, if the naked shorts and shorts had to close out their positions and had to return these synthetic shares because it was less profitable for them, because it's currently more profitable for them to fail to deliver. But they may not have a choice. If they didn't have access to this information, if they didn't have access to your order before they actually processed it in the dark pools because the orders were going to lit markets, this would be exponentially higher than a 12% gain in the last 5 days. That's the whole purpose behind what we wanted to do with the creation of Lit Exchange back in 2021. We've been working on this and developing it now for 3 years, since September of 2021. And the whole purposes are to allow orders to be routed directly to lit markets without having to jump through flaming hoops of fire in hopes of doing so. Because brokerages like Robinhood and Webull are not letting you do that. Go check it out. You might actually like what you see. I can guarantee you that. Cheers, my friend.